Most businesses don't fail because of bad ideas. They fail because a few important numbers were ignored for too long. Sales looked fine, customers were coming in, the owner was working hard every day. But behind the scenes, a few silent finance numbers were slowly killing the business. In this video, you will learn 5 business finance numbers. Decide if your business survives or fail. Ignoring numbers 3 and 4 puts your business on a path to failure. Number 1. The oxygen number. I call this the oxygen number because this is how long your business can breathe if nothing new comes in. This number answers one simple question. If revenue stopped today, how many months would your business survive? To calculate it, take your current cash balance and divide it by your average monthly operating expenses. Rent, payroll, software, utilities, insurance, loan payments, everything required to keep the lights on. For example, if your business has $120,000 in cash and spends $30,000 per month, your oxygen number is 4 months. Here's why this matters. Many business owners only look at profits, but profitable businesses still fail because they run out of cash before profits arrive. A healthy small business usually aims for 6 to 12 months of runway. Anything below 3 months is a danger zone. Decisions become emotional. You start accepting bad clients, cutting corners, or taking expensive debt. This number gives you power. With a strong runway, you negotiate better, plan calmly, and grow strategically. Without it, every unexpected expense becomes a crisis. Your oxygen number doesn't lie. It tells you how safe your business really is. Number 2. The reality check number, true monthly burn. Most businesses underestimate how much money they actually burn every month. That's why I call this the reality check number. This is not just expenses on paper. This is real cash leaving your bank account every month. It includes obvious costs like payroll and rent, but also hidden ones like subscriptions, payment processing fees, refunds, small tools, and owner withdrawals. Many owners think, my burn rate is $20,000. But when you pull bank statements, the real number is $27,000. That gap is deadly. Why? Because growth decisions are made based on false assumptions. You think you can afford a hire. You think you can survive a slow month. You think profits are higher than they really are. To calculate this correctly, look at actual bank outflow, not accounting categories. Average it over 3 to 6 months. Once you know your real burn, planning becomes accurate. You can forecast cash properly. You know exactly how much revenue you need just to stay alive. This number forces honesty. And in business finance, honesty beats optimism every time. Number 3. The leak detector number, hidden cost percentage. Every business leaks money. The problem is most owners don't know where. The leak detector number shows how much of your revenue disappears into hidden or unmanaged costs. This includes waste, inefficiencies, unused software, poor inventory control, overtime misuse, rework, bad pricing decisions, and delayed collections. To find it, compare expected margin versus actual margin. If you expect a 40% gross margin but consistently land at 30%, that missing 10% is your leak. For example, on $1 million in revenue, a 10% leak equals $100,000, quietly gone. No dramatic failure, no warning sign, just slow bleeding. Businesses with strong financial systems actively hunt leaks every quarter. They renegotiate vendors. They remove unused tools. They fix pricing logic. Weak businesses blame the market. Strong businesses fix the math. This number matters because improving it doesn't require more sales. It requires better control. Fixing leaks is often the fastest way to increase profits without increasing workload. Number 4. The stress test number break-even pressure point. The stress test number tells you how much revenue your business must generate every month just to survive. No profit, no growth, just survival. This is your break-even point, calculated by dividing your fixed monthly costs by your average gross margin. For example, if fixed costs are $50,000 and your gross margin is 50%, you must generate $100,000 in monthly revenue just to break even. Anything below that creates stress. Anything above creates breathing room. Why this number matters. It shows how fragile or resilient your business model really is. If your break-even point is too high, a small dip in sales becomes dangerous. If it's low, your business can absorb shocks. Smart owners work to lower this number over time. They control fixed costs. They improve margins. They build flexible cost structures. This number explains why some businesses survive recessions and others collapse overnight. This number also helps you plan pricing and promotions safely. When you know your exact break-even pressure point, you stop offering random discounts that hurt margins. You can test worst-case scenarios like seasonal slowdowns or demand drops and still stay calm. Businesses that track this number don't panic during slow months because they already planned for them. Number 5. The control number. Owner dependency ratio. This is one of the most ignored numbers in small businesses. The control number measures how dependent the business is on the owner. Ask this question. What percentage of revenue would stop if the owner stepped away for 30 days? If the answer is 80% or higher, you don't own a business. You own a stressful job. High dependency increases risk. Illness, burnout, travel, or emergencies can instantly affect revenue. Businesses that scale successfully reduce this number intentionally. They build systems. They delegate sales, operations, and decision-making. They document processes. A healthier business keeps owner dependency below 30 to 40%. This number matters because buyers, investors, and even lenders look at it closely. A business that runs without the owner has value. One that collapses without them does not. Reducing this number gives you freedom. And freedom is one of the real goals of business ownership.